Hello, I'm Mary Staver, President of the Royal Neighbors Foundation. We are so pleased you have joined us for some tips about successfully managing your money. The mission of the Royal Neighbors Foundation is to help women build better lives for themselves and their families through better management of their finances. As a 501c3 public charity dedicated to building women's futures through financial education, the goal of the foundation is to reach out to women across the country and provide them the tools they need to help them become more financially secure. Because when you think about it, money really is a tool that if used properly can help you build something great. We recognize women's abilities to juggle it all while maintaining a strong foundation of financial knowledge. And if you feel you already have a firm grasp on your finances, that's great. But no matter how much we know about money, we can always learn more. That's why we are so proud to bring you valuable information through our webinars that may be new to you or may just serve as a gentle reminder to be more proactive as you plan for a secure financial future. These free educational webinars are made possible by the generous donations to the Royal Neighbors Foundation by individuals across the country who believe in the importance of our mission to help women and their families plan and build for a comfortable and secure life. Thank you to all who have contributed. You are our heroes. Now, let's get started learning more about how to successfully manage our finances. I would like to introduce Cynthia Tidwell, board member of the Foundation and President CEO of Royal Neighbors of America. She is here to share her thoughts about knowing your worth and empowering your financial future.
Thank you for joining us. We are going to explore the best ways to manage our financial goals. The Royal Neighbors Foundation believes in women knowing their worth. We want women to live successful, healthy, fulfilling lives. But without financial security, sometimes it's difficult to achieve all those things. Knowing and appreciating our worth is a great start. Let me ask you a question. With all you do, your family, friends, employer, community, do you ever feel like there's not enough hours in the day? Well, I'm right there with you. Women learn at a very young age how to juggle time and meet many competing demands. For example, can anyone relate to multiple roles? For most of us, we find ourselves wearing many hats throughout the day. We're all daughters, except for the men in the room. Sister, aunt, business owner, maybe a wife, mother. Can you relate to cook and grocery shopper, nurse, chauffeur, housekeeper, accountant, employee, and of course we're all friends. For most of us, this is our lives. It's full to the point of overflowing. But right now, this is about you. I want you to think about your future and your dreams and the actions that will take to make those things happen. This is about taking the next step, or in some cases, the first step on your financial journey. In spite of often being on overload, that overload has resulted in great strides by many women. There was a point in history when women couldn't own property, weren't considered smart enough to handle business or financial matters, weren't worthy enough to be insured, and we couldn't even vote. Then through the determination and hard work of some very smart and inspiring women throughout history, we now can vote. We can own homes and businesses, we can get as many college degrees as we want, and we can even be the boss. But we also have the opportunity to earn, save, and spend our money any way that we want. But with that comes responsibility and accountability, both of which seem to go greater and more challenging with each passing year. Balancing family, career, health, aging parents, and then making time to learn more about money and investing is very demanding. We've learned that to be responsible, though, you have to make choices, and you have to live with the consequences of those choices. Sometimes that's scary, sometimes it's exciting, and quite often, it's both. One of my favorite sayings is, if you plan, it might happen. If you don't plan, it will never happen. Today, we will plan. But first, before we plan, we need to know our worth. What's the first thing that comes to mind when you hear the phrase, know your worth? We've got many kinds of worth. Do you know your worth in all the roles that you play? As a daughter, maybe a business owner, a wife, mother, friend, employee. You've got emotional worth. You've got spiritual worth. Many kinds of worth. Today, do you know your net worth? We're here to concentrate on your financial worth today, making the most of dollars and cents by using good sense, balancing security for the future, which we all need, but still living for today. Now, there are 4 steps to leading a financially secure future: knowing your worth, defining your goals, designing your plan, and then finally, the most important one, taking action. Much of what we're going to talk about today, you may have already heard. But knowing and doing sometimes are 2 very different things. So let's begin by knowing our worth. Here's something to think about. 90% of women will have sole responsibility for their finances at some point in their lifetime. This is why it's so important that we know how to handle money and we know our financial worth. And it doesn't matter how much money we make. Whatever the amount, we all need to know how much we have, where it's going, and how we can save more. So the first step is really to face reality and understand where we really are today, your situational assessment. In order to do that, you need a financial scorecard of sorts. This scorecard is the backdrop which you will make many financial decisions against. So we start by tracking our assets. Assets are a word for what you own. It's everything you own, from your house, possessions, savings, maybe a 401k, life insurance, cash value. So you have to know what you have. Then you have to track your liabilities. What's a liability? It's kind of a fancy name for what you owe. It's what you owe others. It could be your mortgage, maybe student debt, credit cards, loans. So you subtract your liabilities from your assets, what you owe from what you own, and that is your net worth. To increase our net worth, we either need to have more assets or fewer liabilities. That sounds pretty simple, right? In practice, not so much. So we need to understand that. The next item on our scorecard is really income and expenses. So what's coming in and what's going out. The net of that number is what you can save. Now, planning our financial future without these basic scorecard measures is like driving a car without gauges. You need to know how fast you're going, how much gas you have, if the engine light is on in order to get to your destination. These scorecard measures become the departure point for your financial journey. Understanding your income dictates how much money you can spend and save and what you need to earn on your investments in the future to be financially secure. Knowing your worth and then making decisions to grow your money empowers us to make better financial decisions. So now we have some key measures in place. We know our net worth, we know what's coming in, we know what's going out. Let's define our goals. So before I go any further, I want you to personally think about 2 financial goals that you have. I want you to pick a short-term one and a long-term one, and what you would like to reach, and think about the obstacles that may be hindering your success right now. Now I want you to keep those in mind as we go throughout the rest of this presentation. So let's start by defining our goals, both financially and lifestyle, because they're intertwined. This is to determine what's really important to you. It might be sending your children to college, expanding your business, buying a home or maybe moving into another neighborhood, becoming debt-free, planning for retirement. Every one of us has different ideas, different goals, and quite frankly, it could even be all of those things. Whatever your goals are, you need to be specific and write them down. The more specific you can be with your financial goals and visualize the end, the more likely you are to actually reach them. So what do I mean by that? You could say, oh, someday I want to retire comfortably. Or, I want to retire at age 62. I want to be in the mountains of Colorado in a 2-bedroom, 2-bath, single-family home near a golf course and a ski slope. Can you see that? Can you visualize that? Or maybe I want to pay off my student loan in 5 years to buy a new car, but not just any car. I want the Volvo hatchback with the nav system in blue. Or my first home. I want my first home by 35. That's a goal. Versus, I want a 2-bedroom home with hardwood floors and neighborhood park with good schools. Expanding your business. I want to grow my business. Or I want 3 new locations in a good business district within the next 5 years. If you actually see yourself in one of these, if you see yourself in the house, in the mountains, it's a lot easier to save money when you're challenged with an expenditure versus the abstract idea of, I want to retire one day. So this is really, you need to define your goals, your motivation, your reality check. What is it going to take to get there? Are your goals realistic, or do they need to be revised? So once you're clear on your goals, you may have multiple goals over a period of time, you need to design a plan. Now, goals need money. So designing your plan starts with a budget. Budgeting allows us to monitor our expenses and identify additional savings opportunities. It's the best way to understand how and where to save more money. I know budgeting sounds like a no-brainer. In theory, we all know how to do it, but in America, we still don't do it very well. The important thing about a budget is to include all your expenses, not just the big monthly expenses like your mortgage or your rent, utilities, food, but you got to put everything in there. Clothing, haircuts, car insurance, insurance payments. But it's also maybe the bagel you buy a couple times a week, the cup of coffee you have with friends at the coffee shop, all your entertainment expenses. Your budget has to include everything that goes out the door. So if you take what's coming in and you subtract your budget, that's what you can save. So hopefully at the end of the month, that's what's actually happening. But if you want to save more, what do? You either have to cut your expenses or you have to bring in more money. So here are some tips that we need to look at on our financial journey. These things have worked for me over the years. It's very important to pay yourself first. So what do I mean by this? You make so much money, they take out taxes. But if you can put money into a savings account or your 401k before it ever hits your paycheck, before it ever gets in direct deposit, it's by far the easiest and most effective way to save money. And many employers help us out now with direct deposit options. What you don't see in your paycheck, you don't miss. What you see in your paycheck, you want to spend. So number 2, we need to plan for emergencies. Statistics show that nearly 50% of Americans are living paycheck to paycheck. 62% of Americans cannot cover an unexpected expense in the $1,000 range. That could be a broken washing machine, something wrong with the car. It happens all the time. No matter how well we plan, we will face these types of emergencies, and sometimes even worse. It could be an illness, loss of a job. Now, I know this sounds like a lot, but your goal should be to put away 3 to 6 months of your salary for emergencies. 3, pay off debt. Start with those dang credit cards. If you have student loans, work on getting those paid off, and then you chip away at your other types of debt. Might be a car loan, maybe a home equity loan. Try to get those cleaned up. And then saving for retirement. Take advantage of any 401k plan that your company might have. Because regardless of our age, we need to start thinking about retirement earlier and earlier. The earlier, the better. And then really the 5th thing that we need to think about is investing. But before you have thoughts about investing, make sure that your savings, emergency fund, and debt plans are all under control before you start with heavy investing. But when you are ready to invest, begin by doing some research on your own. You really need to get an idea of the best options for your comfort level in investing. You could get a trusted advisor who can help you determine what it's going to take and where you want to go. You need to take things into account like inflation, income, lifestyle. And if you want an advisor, don't be afraid to shop around. Look for someone who wants to get to know you, who will listen to you, ask you questions, learn about you and your financial situation. And be sure to check out credentials. If you use an advisor, they can also help you understand things like diversification, the amount of risk that you might be comfortable with, and things that we don't talk about a lot is fees associated with the investments that you make. Now, of course, you can do planning on your own as well. You don't necessarily have to have an advisor. There are a number of great tools that you can use, and people are self-directing their funds today all the time. There are even websites where you can make a mock pretend portfolio and see how good you actually are at this before you use your own money. And the final step is to take action. None of this matters if we don't take action. That means managing to your budget. So take a few minutes and think about where your money goes, because we all have these things that I call wealth detractors that defer us from taking some of the action that we might want to take. So for example, do you take your lunch to work, or do you go out to lunch every day? Do you spend $5 to $10 a day to eat at a nearby restaurant? Do the math. $10 a day, 5 days a week, 52 weeks, $2,600 a year. Now, if you invested that $2,600 for the year, for the next 20 years, and got an average rate of return of about 5%, you'd have about $90,000 saved. So do you stop at the coffee shop? It's so convenient, and I got my special footsie foo-foo coffee because it's right on the way to the office? Or do you fill up your mug at home, maybe in the lunch break room? Or do you buy the pair of black shoes, another pair of black shoes that go perfectly with the great new dress? Or do you wear one of the other numerous pairs of black shoes that you already have in the closet? This is my weakness. Do you get caught up in a sale? I love sales. Only to find out that what you bought doesn't fit, not the right color, and it just sits there. Honestly, we probably all do a combination of some of these things, and I could go on with many, many other examples. But think about it. It's wiser to put some of that money in the savings account instead. If I spent some money on shoes and stuck it in my investment account instead, I could have some nice money at the end of a 20-year period. Now, don't get me wrong, we have to live for today, so one pair of shoes, no big deal. Lots of shoes, lots of coffee, lots of lunches, it all starts to add up. Next, pay off those credit cards. Remember the black shoes you bought that you really didn't need? Well, if you put them on a credit card and didn't pay that off at the end of the month, you've now just added insult to injury. You have to pay the high interest rate versus the positive effect if you had put that money into a savings vehicle. Now, credit cards today have different types of balances and different types of rates, but they average somewhere between 10 and 20%. So it's important to get those paid off as soon as possible, paying off the ones with the highest interest rate first, even if the balance is smaller. Remember the $2,600 that we were paying to buy lunches? This is amazing. If you had that on a credit card, so you bought all your lunches on a credit card for the year at 18% interest, and you only paid $40 a month to pay off that credit card, it would take you 18 years to pay off that $2,600. That $2,600 at 18% interest now turns into $8,600. Now that's if you don't add anything else to the credit card. So think about it. 1 year of lunches, if you're not managing your credit card well and you slap it on the card, could take you 18 years to pay off. Important to try to pay those off every month. If you think about those numbers, it makes you think twice about some of your spending habits. So let's move to student loans. Student loans is a big issue right now, and many student loans need to be repaid. So here's some tips. Treat them like a mortgage payment and try to make a larger payment to the principal every month to get it paid off sooner. Or split your monthly payments in half, paying them every 2 weeks instead of monthly, and you'll wind up making a whole additional payment every year. Pay them off quicker. Now do research on various loans. Pay the loans off with the highest rate first, again, common sense, and then consider consolidating and, if possible, maybe refinancing all of that debt into something at a lower rate. Now, you can also take unexpected funds that you might get, like bonuses, a tax refund, inheritance, and get those loans paid off. When filing for your annual taxes, be sure you take advantage of the interest tax credits and deductions for the interest that's available to you. Every day we make choices on how we spend our money. Now, these choices all have consequences, some of which I've just explained, both good and bad. So what if you want to save for your children's education? That's something that's always top of mind. There are many options available. There are 529 plans. Some colleges you can do prepaid tuition for your children. There's something called a Coverdell Education Savings Account. You can use IRAs, and there are even qualified savings bonds. What about retirement? Well, it depends on where you are in your life, but it's never too early to plan for retirement. If you have a defined benefit plan or a traditional pension plan, you're extremely fortunate. These plans provide guaranteed income for life. Many of our parents might have been on these plans through the businesses that they worked with, but today they're going away rapidly. So we have to fund our retirement another way. Many companies have moved to defined contribution plans, 401ks. If you have one, take advantage of the 401k and make maximum contributions. Now, if you can't make the maximum contribution right away, develop a build-up plan so that eventually and as quickly as possible, you can max out that 401k. Now, this could be your main retirement vehicle, so don't touch it. Let it grow. Now, our life experiences are different, and maybe some of us didn't have the opportunity to start saving for retirement in our 20s or 30s. However, it's never too late to take control, and the sooner you do, the better. Here's an example. If you had invested $1,000 in the S&P stock market each year since 1996, the value today would be $55,000. So you took a $20,000 investment, and now it's turned into $55,000. That's the power of consistently investing over time. So if you're entering the savings and investment game later than expected, you may have to increase the amount you save and you may possibly have to redefine your goals. Some may have to find that they have to work sporadically during retirement to earn extra income to have the lifestyle that they want. Saving money for the rest of your life is a huge responsibility. Outliving our money is a very scary thought. Social Security is uncertain, healthcare costs are rising, family dynamics are changing. Here's a current statistic. 50% of people 50 years old have less than $50,000 saved for retirement. That's enough for about 2 years, actually only 16 months. So I don't know very many people that want to retire at 65 only to go back to work at 67. But we must take action. So remember that scorecard I talked about earlier? We need to update it and review it regularly, and if we're married, with our spouse. We need to review the budget, our bank statements and investments at least twice a year, and we need to check our credit score at least annually. Now, if your credit score isn't where you'd like it to be, you can rebuild it. There are things you can do to improve it, but they take time and they take discipline. Now take a moment to think about the short-term and long-term goals and obstacles that we talked about in the beginning of this presentation. Do you feel better about reaching those goals? Do you maybe need to rethink a few things? Now we have tools on our website that can help put information down on paper and get you on the right path. You can't just think these things in your head. We have to translate them down into paper and see them and visualize them. And we have to remember that it's important to protect what we're building. Life insurance is one of those things that many women don't want to think about. It's not mandatory, but it is so necessary. Today, we know that 40% of women are the sole breadwinners in households with children. Think about that. Women are making more money than ever, and families are relying on it, but we're still significantly underinsured. If something happens to you, how will your family remain in their home, send the kids to school, maybe even as basic as just paying child care? Life insurance can provide you that comfort of knowing that you've protected what's important in your life. Not only is your family protected when you die, there are some policies that can offer financial assistance even during times of significant illness. So if you don't have life insurance, do some research, work with a licensed agent to buy the right type of policy for your life stage. There are also many online tools that can help you calculate the amount of insurance that you might need and explain the different types of options out there. For instance, you can find many types of calculators and descriptions of different types of policies at the Royal Neighbors of America website, www.royalneighbors.org. The more we know, the more confident we can make the right choices. But the key is to save and grow your money. We must follow the 4 steps that I talked about today. Know your worth. Define our goals. Design a plan and take action. If you do nothing else, start taking action. I hope what you have learned here you act on, and you give the gift of sharing it with others. Thank you for joining me and learning more about knowing your worth and empowering your financial futures. Now, everyone's situation is quite different, but my advice would be not to do that. Now, I know the cost of college is skyrocketing, but we have to be very diligent that our kids are our children. We need to help them, but we shouldn't impact our long-term goals or retirement just for college. There are other things that we can do that a lot of people don't want to. You can consider maybe a junior college for the first couple of years to get your requirements out of the way. I know it's not the college experience we dream for our children, but we have to be realistic. The cost of college today is somewhat out of reach for many families. We've got to rethink how we're going to educate our children in the future. Now, there are loans available, but we need good guidance before our children start taking loans for college. I've talked to many young people who took too many loans. Too many loans, they didn't get the right advice, and their degree is not going to give them the opportunity, the earning power to pay back those loans in a reasonable period of time. So it's a complicated question, but I would advise not taking money out of your 401k for college education. Well, life insurance can pay for final expenses, so we're talking about things like funerals. So the family, as you get older, you worry about making sure that your family doesn't have to pay to bury you and have a funeral. But life insurance is so much more than that. And it really depends on where you are in your life stage. As you're starting out, maybe you're getting married and having children, you need more protection. You want to make sure that your children and your spouse can continue the lifestyle that they have should, God forbid, something happen to you. Life insurance can also be used as a savings vehicle. You can put money in there, certain types of policies, grow your money, and then you have options to use that money later in life. You have options maybe to use some of that for college because your protection years are now no longer needed. So there's a lot of things that you can do with life insurance. Life insurance, many types of policies also have what's called living benefits. So there are many policies that you can actually tap into while you're still alive, usually in the cases of significant illness, if you need that money before you pass away. Financial advisors, 50% of widows change financial advisors after the death of their spouse. And it's usually because that financial advisor didn't pay a whole lot of attention to them when the spouse was alive, or they don't have confidence. It's very easy to change financial advisors. It's uncomfortable because you have to go to that person and tell them that you're going to be moving your money. But you can also go to a new advisor and they can set things up to automatically move that money. It's actually quite easy once you get over the emotional hurdle that you need to do this. "10 years ago, max out that 401k as soon as you can. I can't stress that enough. And if your company matches part of your contribution, that is just money you're leaving on the table. Max that 401k. Right now, it is really, other than Social Security and what you save on your own, the only other type of retirement vehicle that is in place. So 35 may sound very young, but in a blink of an eye, you're getting ready for retirement. Start as young as you can. Reduce your expenses, pay off your debt. Don't take money out of your 401k. There are times, and there are some people that can take all their high interest debt and get another loan and pay it off. But a lot of those people then just rack up more debt because now they've paid off this, they're paying it at a lower interest rate, so it may have lowered their expenses. Unfortunately, most people don't save that difference. They just spend it on something else, wind up with more debt, and it becomes a vicious circle. We've got to get under control the budget. So my advice is to hit those highest interest credit cards first, hit that highest interest debt first, and pay it off and pay it off. Hit the next one, and don't borrow to pay for something that you've already spent.